Welcome back to our intermediate financial accounting class. Over the last few segments, we've been talking about inventory, specifically about lower of cost or market and ending inventory estimates. Now we get to wrap up that discussion of inventory and of our current assets and start talking about a whole new category of assets. You remember we started our discussion talking about the accounting cycle, and now we're into the asset section of the balance sheet. And our previous module, which we just finished up, was all about current assets, and now we get to move into long-term assets. And we're going to break that discussion into two pieces. We'll talk about PP&E, and then we'll talk about inventory. And under PP&E, we're going to start by talking about capitalizing PP&E costs, and then later on, we'll review depreciation. Let's get started. So let's talk about property, plant, and equipment, and we want to begin our discussion by talking about why we should care about PP&E. Well, while most companies make their money selling inventory, they can't do that without property, plant, and equipment. Either you need the equipment to build this inventory that you're going to sell, or your PP&E or your buildings, your warehouses, your shipping fleet of trucks or planes or whatever it is that allow you to get your goods to your consumers. So without property, plant, and equipment, there aren't any sales either. So it's another important part of our asset mix. In addition, companies are buying property, plant, and equipment constantly. Now, it's not an everyday operation like selling inventory, but it's an important part of doing business. Whether we're trying to grow the business by buying more long-term assets, buildings, equipment, etc., or whether we're just trying to maintain our business, we still have this steady flow over every fiscal period of cash going out and equipment coming into our business. The only time you don't see this flow is for a company that's in financial distress. It's one of the signals that a company is starting to have problems when they can't afford to invest in long-term assets, or when they start to sell off their long-term assets. Either they're restructuring because they've had some trouble and they're trying to downsize and get back to a core competency, which is a good thing, assuming they pull it off, or it means that they're in trouble and they have no choice. They're selling off long-term assets just to stay in business for the short term. And then it's a really bad sign. Because it's such an important piece, we really need to know what goes into property, plant, and equipment, what costs are included, how we determine our net value or our residual value of our historical cost is important, both from an internal accountant's perspective who's doing the calculations, from an auditor's perspective who's checking those calculations, or from a manager or outside analyst's point of view, trying to decide, hey, are we doing a good job? Is this right? Is this wrong? Do we need to change up our structure? All of those individuals, or all of these different groups of people, have the need to understand property, plant, and equipment, just so we can decide if this is really a good investment or not. Now that we know PP&E is such an important piece, not only of the business itself, but also the accounting records, let's talk a little bit about PP&E and what distinguishes it from other assets. First and foremost, these are assets that we have purchased to use, not purchased to resell to somebody else. We might sell them eventually. You know, I've had this truck for 20 years, it's wearing out, I bought a new one, let's sell it off to a junkyard or something for $500. So I'm going to sell it, but I don't sell it to make a significant profit. This is not what I normally do. I'm not churning through this stuff. So that's the first characteristic that distinguishes PP&E. The second is the fact that we depreciate it over a long period of time, except of course for land, which doesn't depreciate. I mean, unless you drop an atomic bomb on it, land's still going to be there when you're done using it. It might be dirty, but it'll still be there. Depreciation we'll talk about more in a later lecture, but for now, just as a brief reminder, depreciation is keeping track of the wear and tear on these assets. So we buy them, we put them into our books as an asset, and then we slowly write off that asset, showing an expense period by period as we use up the value that we've invested into it. We'll talk about that more later, but for now, just this idea that these are assets that we're going to slowly use up over time to generate revenue in any given period is an important concept. The last thing is that PP&E has a physical presence, and this is what distinguishes it from intangibles. Intangible assets also are long-term investments. They also get depreciated or amortized, but they don't have a physical presence. You can't touch a patent or a copyright. I mean, you can touch the paper, but the true asset is not something that you can really touch. And so that's what we're talking about with PP&E. So that's what distinguishes PP&E. It's the physical assets. Trucks, buildings, land, equipment, etc. Now, for most businesses, PP&E make up a significant portion of their balance sheet. There's a lot of assets involved for most companies in this PP&E section. A lot tied up that hopefully they're using well. So one of the important issues for us as accountants is deciding, well, how much goes into these asset accounts? What shows up on the balance sheet, and what do we just write off over time as an expense? With these characteristics in mind, let's transition a little bit and talk about what actually shows up in those asset accounts. The idea here is that we're going to capitalize some of our costs, and this idea of capitalization is one of our key concepts. You have to be familiar with this idea. We use the term a lot. What capitalization means is that instead of expensing a cost, we put it into a long-term asset account. Now, we're not talking about buying inventory and then selling it off immediately. Capitalization refers to long-term assets, PP&E and intangibles. We're purchasing them to use them over time to grow our business or maintain our business or this particular line of our business, whatever it is. We want to keep track of those costs. So those costs, again, instead of expensing them and just showing them as a rent expense or a maintenance expense or whatever, now, instead we add them into our PP&E account. So the journal entry for capitalization, it's a debit to PP&E or intangibles and a credit to cash or some kind of a loan. Make sure you're comfortable with this idea. Capitalization is putting these costs into a long-term asset and not just expensing them away. And I know I've said that several times because it's so important that you understand what capitalization means and can use that term. This is something you need to walk out if you're knowing. So what gets included in PP&E? What gets capitalized? Well, it's the cost to get the asset ready to use. So this includes the purchase price and then everything else we spend to tailor that asset and prepare it so it's ready for us to walk in and use. So if I buy a building and then have to do some remodeling, all of that would become capitalized, become part of that asset. If I buy a company car and it has to be refitted so that I can carry my display models for my sales associates, then that would become part of the value of that car. So that's what we're talking about. And let's take a look at a few specific examples. Let's talk specifically about what goes into land, and then we'll do buildings, and then we'll do equipment. So land specifically includes the purchase price. It includes closing costs, attorney fees, all the other fees and assessments that have to be done as part of the purchase of the land. So all of this loan stuff and city stuff, inspections and whatever. Next, if we take out a loan or a mortgage or any other obligations that we assume, so if I buy it from you and as part of our deal you transfer over your mortgage to me and I pay the balance of it, then I include the value of that mortgage, the present value of it, as part of the land that I am buying. So that would become part of my land account. Next, if I have to go through and clear away brush, if I've got to demolish an old building, etc., all of those costs become part of the value of my land. Now, most of that is pretty self-explanatory. Again, it's what we spend getting the asset ready to use. So all of that hopefully makes sense, right? I have to have these inspections, I've got to pay the attorney, I've got to pay a realtor, all that stuff becomes part of the value of this land. The other thing that's maybe not as commonly talked about are improvements with indefinite life. If I make an improvement to a piece of land as part of building a building or putting in a warehouse or whatever, that will not go away, then I capitalize that as part of my land. Perhaps the best example of this is if you've ever watched a new subdivision going in. And they come in and they're going to grade, they're going to rip out all the trees and any old buildings that are there. They're going to grade it and get it all level so they can build. They're going to put in the pipelines and the streets and the sidewalks, etc. And then they start to dig the foundations of the different houses or the buildings that they're building. So of that process, most of that becomes part of the value of the land. The grading and getting it level, if they have to put in a retaining wall, etc. All of that is considered permanent. It's going to be there forever as part of that land. So we make it part of the land by capitalizing all of those costs. In addition, the sidewalks, the streets, they're not part of these houses. They're part of the land. I've changed the land in a permanent way. And so that gets capitalized as well. The rest of it, once we transition, start digging foundations, that's where it changes and we start to talk about individual buildings, because I could come in, fill those holes in, and use it for something else later. So that's what we're talking about with land and what gets capitalized there. Again, it's whatever I spend to get ready to use it, but everything I'm going to spend getting ready to use it. Not just some of it, but all of it.
Now, I will mention here before we move on, we're going to talk about buildings and equipment, like I said, here in a second. But before I go on, I just want to mention, remember that land doesn't get depreciated. So you have to be very clear and very open with your auditors about what you're including in your land and make sure it's justified. This really is necessary for me to use this land the way I need to. And these really do have indefinite life, these improvements that I've made. If you can't prove it, you're going to have to kick it into the building so that it gets depreciated. So because it's non-depreciable, we're a little bit more careful with the values that are allowed into land. Buildings, of course, are depreciated over time, and so we're not quite as strict on what costs we allow you to include, but we still are a little strict because buildings get depreciated over like 30 years, usually, which means that it's going to be broken down into a lot of small pieces. So again, you got to be careful. We're not going to let you capitalize into your building account expenses that are part of equipment that you can then depreciate over 30 years instead of 10. So we just have to be careful here. First, you got to have your purchase price, whatever you spend on the building. If you have to pay for permits or inspection fees, etc., that becomes part of the building. If you pay for a realtor to come in and help you with this purchase, those costs can be capitalized as well, although those you have to kind of differentiate between the building and the land, and that becomes a little bit harder. Finally, if we have to do any repairs or do any construction to get that asset ready for us to use, that gets capitalized as well. So we come in, there's a problem in the foundation, price was lowered a little bit, but now I have to fix that foundation. Those foundation costs, those repair costs, would be capitalized into the building as well. Same idea if I buy an old restaurant building and turn it into a bank. I saw one of those the other day. Obviously it was an old drive-in or something and they converted it into a bank. It would take me quite a bit of work to strip out the walls and the restaurant equipment and all that stuff, the old freezers and whatnot, and get it ready for me to use as a bank. I've got to install a vault, etc. So all of that would be part of the cost of this building because I can't use it until I've gotten all of that done. And so that's kind of the key idea here, is that you're going to capitalize everything you spend getting that asset ready for your company to use. And we're going to keep that rule in mind as we transition here to equipment. Same idea, whatever we spend on it, purchase price. If we have to pay for the shipping and shipping insurance to get it to our building, that gets capitalized. If we have to have it assembled, whether we do the assembly or we pay somebody else to come in and do the assembly, that cost gets capitalized. And finally, if I have to do a bunch of trial runs on a piece of equipment, then that becomes part of the capitalized value of my asset as well. So again, there's that same rule of thumb. Do I have to spend it to use it? Then it becomes capitalized. Just be careful with that rule of thumb. As with all rules of thumb, they're not 100% always. This is exactly what it's supposed to be. You have to use your judgment. Before we wrap this up, let me take 1 minute to just share a quick story that a friend of mine shared with me. He was a union representative at a manufacturing company. Now he teaches accounting, kind of an interesting transition, but he tells a story about a huge piece of equipment that his company was building. And we're not talking about one or two pieces that are part of a line. No, this one piece of equipment was the line. Everything from raw materials to finished goods. And they started doing all these designs and production schemes and going through this process with the engineers. And my friend, he was the union rep over the workers, mechanics, line operators, etc. And he said, you really should get us involved in this. And the company said, no, we don't need you, we've got the engineers. And he threw some union weight around, convinced them, more to shut him up, I think, than anything, that they needed these mechanics and others involved. And so they brought him in, and they had all sorts of discussions with the engineers and just really blew the minds of these technical people, because the mechanic would say, you're right, it's easier to put that valve up there, but if that valve gets blocked and I have to fix it, it's going to take me 3 days to build a scaffolding, to get up there, to clean it out, to fix it. If you put it down here on ground level where I can just get right to it, instead of shutting the line down for days, I can do it in an hour or so with my crew, because I don't have to build anything to get up there. And those were the kind of things that these individuals who actually would work on the equipment were able to come up with. The line individuals were able to talk about different processes and techniques they could use to speed things up. Yeah, you don't need to automate that. We can do it really, really fast. Or if you automate this part instead, you'll save 3 or 4 different employees that now can work on something else, etc. Well, they designed it so well that everything got shipped off to Europe, it got made, it got brought back, and the company was planning on the trial runs taking a month or more to get this piece of equipment really ready to use. Well, they assembled it all, got it running, and within 24 hours, they were ready to start running quality product. Not the shoddy, oh, we've got to line this up, we've got to fix, or we've got to change whatever. No, within 24 hours, they were ready. So from a business perspective, this was awesome. We've got this machine, it's ready to go, let's move on. But the accountants actually stepped in and said, we're not ready for this. We're not ready. We planned on much more time capitalizing. You don't have the cash on hand to start production. You don't have other resources ready to go. And we're right at year end. You can't start this now. And they actually ran several extra days of trial runs, confirming that it was really working and capitalizing all of that, because they weren't ready from a financial accounting perspective to start running and expensing production, which would have had to become part of inventory or cost of goods sold instead of being capitalized and depreciated. So this can be big money that we're talking about here. This capitalization really can become a big part of what companies do. Now, we've talked about a lot of different ideas and concepts. When we come back, we'll start talking about a few more details and then doing some actual transactions and calculations. See you then.